Hello everyone, this is going to be a very short video to explain Vanguard Portfolio Watch, which is not a very popularly discussed tool that Vanguard provides, but I think is very powerful and can very quickly give you a sense of how your portfolio is doing right now, how it's designed, and what steps you can take to take it towards your expected portfolio and whatever you want to design it for. So a very quick intro. I've only had 2 or 3 years of investing experience, but I can tell you that this is a very deep topic that can take you 40, 50 years to really get your head around. And people who have been in this industry for even more than that still think that they don't know anything about how the stock market works. And I'm, of course, talking about people like Jack Bogle, who founded Vanguard. But having said that, I think it doesn't take a lot of effort to understand the 4 or 5 key principles that you need to know to be a successful investor. And investing is different from speculating. Speculation is about buying stocks and hoping that they appreciate in value and you could sell them just as you would sell a commodity or like a thing that you bought and only in the hopes of it getting more expensive or having its price appreciated. But investing is about buying something that appreciates in value, not just the price. So anyway, I don't want to go too much into that. This video is more for people who are already have bought into the idea of Vanguard and use it heavily, but may not have come across this tool called Vanguard Portfolio Watch. So I'm assuming that you have sufficient experience in investment, you know the basic terminologies involved, although I'll try and explain all the keywords that I'll come across. And I also assume that you have a Vanguard account. You're using it for some form of investment, either retirement investment or just wealth creation, wealth accumulation, wealth growth, whatever. Okay, so if you have any questions or if something doesn't make sense, please feel free to ask in the comments and I'll answer right away. So coming to the this tool specifically, how you get to it is on your Vanguard page. You go to My Accounts, and there is a tab to go to Portfolio Watch, which takes you to this page. And immediately you see that there are different tabs or slices or different ways of looking at your portfolio. Portfolio basically is the sum total of all the securities that you have bought. So a security could be a stock, a bond, money market funds, or even mutual funds, index funds. So all these terms that I'm throwing out there, hopefully you are familiar with them, but basically they're just things that you buy which hopefully appreciate in value over a long period of time and add to your asset base, right? And they hopefully beat inflation over long periods of time. And it's basically a way for the money that you've earned right now to work even harder for you. Um, so the very first tab that Portfolio Watch has is called Asset Allocation. And what this means is that you have this total sum of assets, right, which is called a portfolio, but it is at a very high level divided into 3 types. There is short-term reserves, there is bonds, and there is stocks. Stocks is basically refers to an ownership, a part of ownership of a company. A bond is essentially a loan that someone takes from you, whereas short-term reserves typically refer to government securities or even just cash. So what you see first of all is at the very high level, this particular portfolio has around 91% in stocks and 9% in bonds and nothing in short-term reserves. So what this should tell you first of all is that this is a very aggressive portfolio. Stocks typically tend to return more than bonds and other forms of security, but only over longer periods of time. So to give you a sense of what I meant here, you see some information over here, which is the historical risk return for this portfolio. So what this is telling you is that over the last 80, 90 years that we have data going back for the US stock market in particular, if someone had this portfolio over this period, the average annual return would have been about 10%. In the best year, it would have appreciated by about 50%, while in the worst year, it would have gone down by 40%. And one quick note here, you would see that usually the worst and the best years tend to be close to each other because they happen in cycles. So usually a period of a very good return is followed by a period of a very bad return, and these things fluctuate, right? So that's why if you take a particular slice in time and you find that the return is very poor, it can very easily happen that you took another slice in time and the return was very good, right? So over a long period of time, you should expect to see the average return, which now is predicted to be somewhere between 6 to 7% looking forward for the next 40 to 50 years. Um, but yeah, so that's the first thing that should tell you about your portfolio. How much do you have in stocks? How much do you have in bonds? And then you can first start by writing these numbers down and then think about what your what your risk tolerance is. And I'll get to this towards the end of the video.